great to see all the bright, shiny faces. Great to see little black boxes with phone numbers on them. I think I know who most of you are. And of course, Lizzie. So, speaking of baby face, everybody can do one of these things. Lizzie turned 21 recently, and I think she's got some shenanigans planned for tonight, but she still made it here end of day to work our call. So thank you very much. Love you, sweetie. And every kid loves when their dad says love you on a public Zoom. So Lizzie, you got that going for you. So in any event, let's get started. We're here today to talk about a little bit of financial planning. And one of the things that I want to go over with everyone is when you have a financial plan, there's one of two types. There's a goals-based plan and there's a cash flow plan. Goals-based is, hey, I want to buy a boat. Hey, I want to buy a house. I have kids to educate and so forth. And cash flow is more of a process-driven type of approach where what you're looking for is what's my stream of income and how will it pay the bills that I need to pay. And for the most part, in our company, we do cash flow planning. To me, it's a way that we can sort of ease the amount of tension that people have about what life is going to look like. And also from a practical standpoint, a majority of our practice is getting to that point where they're thinking about retirement, pre-retirement, or actually in retirement, as opposed to people in their 20s and 30s, where there is really no concept yet of what cash flow should look like in retirement. And also from a peace of mind standpoint, when you have some data points like your income and your assets and an assumed rate of return and all these things that you can think about, your notion of what is predictable is a lot more comfortable. You feel as though you have a lot more within your control. So, the key points to this type of thing are when you're looking at lifetime income, you're not looking at lifetime principal. You don't take your account and start breaking off pieces to spend. You don't sell shares of Apple to pay your bills. You're taking the income that comes in from this chunk of money and also from, say, a pension or Social Security, and that all goes into one stream of income, hopefully growing, and that pays your bills. You don't take your account to the supermarket and treat it like a chunk of gold or coins. It's got a job to do, and it pays you a salary, and hopefully it pays you a sustainable salary. And in our experience, typically the clients who are focused on this cash flow process and who are planning centric just exhibit a greater sense of peace of mind and calm. Now, what we all know and what's on our mind is we live in a nutty world with a lot of things going on that concern us. There's any number of things every day that create this swirling kind of concern about where's it all going. There's pandemics, there's war, there's hyper political strife constantly, and these things always exist. It seems more excessive now, of course, because of the little black device you hold in your hand and the computer, and you're hearing about it at all times. But this is ongoing, and it always happens, and we have to address it. Now, in your retirement planning and in your cash flow planning, it's important to understand what's really important in spite of all that. And there's two essential questions we have to answer. And they are, will your income outlive you? Or will you outlive your income? Clearly what we want is the former. We want to make sure that whatever you have coming in lasts till the bitter end, whenever that may be. And essentially the priorities of our cash flow plan is to really focus in on how to make sure we assess everything so we have a predictable cash flow. And we focus on the two risks that we can control. Now, I'm going to tell you right now, this assumption of risk does not assume the world's going to end. If the world's only going to end once, we can't assess that. And number two, it makes an assumption that you're not going to buy a stock that's of low quality that goes to zero. That aside, the only two real risks we have are time horizon risk. That is, you have a chunk of money and you don't really assess when you're going to need it. You have $100,000, you're going to buy a house and you put it into the market and you need that next year and it's down 10% and you have to sell. That's a risk. Not us understanding when you're going to need money is a risk. The other big risk, and where we'll spend a majority of our time today, is purchasing power. The rational definition that we use for money is purchasing power. Whether we spend a rock, a piece of gold, a euro, a yen, renminbi, or a dollar, it's purchasing power. It's how does what we have continue to be able to purchase goods and services like gasoline and insurance and food and everything like that. So the retirement answer of our income outliving us means that our income must grow at least, if not much more, than the rate of cost of living. And the challenge is to create an income that's dynamic, and it must rise over time to offset inflation. And the critical issue turns out to be really not the level of your income, but its trajectory. So let me use a very basic kind of graph to show this. The black line where it says income, that's what income you need today to live. And for our purposes today, let's make an assumption that you are in retirement and you have a pension and or Social Security and a bunch of assets generating some dividends and interest. And what you need to live every month is $8,000. That's the income. Okay. Now, what's going to happen, of course, is what it costs to live is going to go up. So even if you're fixed income, and we're making an assumption that this line is flat because maybe you want to feel safe and you just want your money in cash or bonds or CDs. Now, even if it's just fine right now, and even if you have plenty of money, your costs imminently, or your costs will go up. Maybe not imminently, but they will go up, and that's inflation. So when and where those lines cross isn't really the issue. The issue is that if they do cross, you start to run out of money. And that's kind of the setup. Now, what we're worried about is purchasing power, and we're worried about these lines crossing, costs of living. So what you have to prepare for, and I know a lot of my clients laugh when we have these conversations where I'll do a simulation with you, and you know the chart goes all the way down to age 100 or 95, and that you always get all sorts of nonsense from clients. Yeah, just put me on a nice flow, or park me by the side of the road, or whatever. But in reality, the average of a couple, you and your partner, who retire at age 62, is about a 30-year lifespan. Now, I know I have probably some CFAs on here and other smarty pants who are, going to talk to me about where the standard deviations are and everything like that. But I'll dispense with that, and I won't bore everybody else to tears. For the most part, this is the average, and it's all in here, okay? And this is where 67% of all the lifespans will end. But I prepare you for this. So you need to prepare for this 3-decade plus retirement plan. And if not, you're taking on a risk. Once again, purchasing power risk. You have to make sure that your money lasts for a theoretical lifespan that could be well over 100. So to look at the numbers in a different way, this is that $8,000 a month that you need in year one of your retirement. Let's make the numbers nice and neat and say January 1st of 2023 is where you start. And you need $8,000. Now, inflation, typical inflation, the trend line of inflation over the last 45 years is about 2.9%. It's a little higher now based on what just happened in the last year, but that's typically where we're going. So for our purposes, let's use 3%. So 3% inflation on $8,000 over 5 years means that what cost you $8,000 in 5 years, what year are we in anyway? 2027 will be $9,200. I've taught some of you the rule of 72. Cool math trick. Einstein came up with it, and it's basically this. If you have 3% inflation, if you have a given rate of inflation, whether it's 3% or 6% or whatever, divide that number into 72, and that will tell you when a number will double. It's a dumb little parlor trick, but 8,000 at 3% doubles in 24 years. 3 into 72 is 24. 8,000, becomes 16,000, right in about year 24. So clearly, 30-year retirement plan, 8,000 becomes 19,000. And how do we increase our income? Now, once again, play along with me. Some of you might serve on boards. Some of you might have pensions with inflation options. But historically, you find rising income in a retirement portfolio by owning stock. Stocks are businesses. Businesses grow. Pam and I start a bakery, and we have investors, and they invest in the business, and they get shares, and Pam and I have shares, and we knock down the wall to the store next door, so we have more space and more seating. We add whole wheat bagels to the menu, and we're adding things on, and we're growing our revenue. We're a company, we're a stock. Microsoft adding cloud, buying LinkedIn, and so on and so forth. This cash flow provides rising income, rising dividends. So in order for us to get from point A to point B, we have to own stock. So I didn't announce there was going to be any lessons or anything like that today, or any type of quizzes, but let's just play a little game here. So the consumer price index, that's inflation. It's an index of different data points that give us a number, a numerical value to express where inflation goes. So since 1960, let's think about, and I want you to write down or think about where you think inflation has gone. And so the dividend of the S&P 500. All right. So that's 62 years. So in 1960, the CPI, the Consumer Price Index inflation, was about 90. Now it's close to 300. I think it's like 297 or something like that. But so what that means is $1 is now $10. But the dividend, $1 in dividend on the S&P 500 is now 30. So had you just sat there in stock, and that's how you were paying your bills, you see one outpaces the other. And by the way, speaking of the S&P, since 1960, the S&P is up about 70 times. That is, the S&P was at about, depending on where you looked at it in 1960, not inflation adjusted, was at about 60. Now it's at about 4,200. So what that allows you to do, of course, is take out some more money and, give it to your heirs or your congregation or so forth. And it helps you build wealth. So you have Social Security, you have a pension, but you need to know your number. Your number is what amount of money generating a certain percentage of distribution will pay your bills. And this is what we talk about at all times. All of your assets that we help you manage, what are they going to do for you? So to calculate your number, it's a simple little trick. It's different for everyone, and it's just an example. But this happens to be a client of ours, and this is their plan for how things are going to look this coming year. So let's just assume that you need $250,000 to live. Let's assume that $50,000 is Social Security. You need $200,000 a year. What number multiplied times 4.5% generates enough money? That number is 4.4. I don't want to weigh everybody down in the math here. I just wanted to show that this is a very rudimentary but very accurate way of assessing where you need to be. And this is all part of a discussion that if you're not a client, you should have with your advisor. And certainly if you are our clients, we have a lot. And the 4.5%, by the way, is a traditional distribution rate. It's a rate below which your success rate is very high, above which you start taking out 10% a year, you have a problem. 4.5% typically means that you have a very high rate of success in a plan. Okay, so looking at this a different way, here's your $200,000. Here's year one, here's your inflation. Inflation, inflation. So we need to increase your cash withdrawals to offset this inflation. Okay? Now, what do we do now? If you're a client, this is a conversation we have all the time. If you're not our client, have this discussion with your advisor. Talk about it with us if you'd like, over a cup of coffee, virtual or real, and we can give you an opinion on where things are. So let's get into the models, the accounts, how they're doing and what we're thinking about at a very, very high level. There's a lot of white noise that we've been hearing. There's inflation, there's recession, there is all sorts of things that are going on that create this quote unquote wall of worry. That they say that the markets always climb, they're always going up in spite of the wall of worry that we face. But what we care about is the opportunities that exist to profit and limiting risk. I'm not interested in all the nonsense. I'm not interested in things I can't control. What I'm interested in is where there's relative value. I'm interested in looking at things where I can increase the amount of income in the portfolios. And I want to make sure that we don't have large drawdowns. That's all well within our control. So what we're doing now is we're very focused in on U.S. equity for the time being. I'm stealing this. I think it was somebody at Fidelity who said to me about a year and a half ago that, they were getting out of China, and it's about when I got out of China. And they said, how can you invest somewhere where there's no rule of law? And it was a great point. And, right now, we're not in China. We have little to no emerging markets. Emerging markets are things like Turkey, Brazil, India, China. It used to be Russia. Russia's really not a factor anymore. We have no Russia. We never had any real allocation unless it was incidental to Russia. And for the foreseeable future, this is where we're going to be. I think at some point, I'll find value and I'll find some momentum in Europe, and we'll be back in. That's a whole other conversation that we don't have to get into today. But there's an overhang in Europe. Their interest rate policy, inflation. The United States has been raising interest rates, and because of that, we're essentially exporting inflation everywhere, including Europe, because the stuff they buy is denominated in dollars. They're not as resilient as the United States, so that's not necessarily a place we want to be. And we are starting to get back into bonds, by the way, which we had been out of for many months. We saw value there, so we're starting to get back into that over the last several weeks. So the model updates. We have several models in the practice. The largest one is the moderate. This is not a composite of all the models or all of the accounts. This is not an audited return. This is an actual client who's representative of this model, because I wanted you to see what's actually happened in a real client account. Everybody in this model is about the same. It's different for different clients because of when they came into the practice. So the stocks and bonds and things were bought at different moments. So the returns are very similar, but not exactly the same. So year to date, through 2 days ago, this client is down 10%, 10.2%. The yield, the interest and dividends in the account are about 2.8%. That means by hook or by crook, no matter what happens, $1 million account will have about $28,000 of cash flow coming into that account. That's important. And of course, that will grow over time. The benchmark is 70-30. 70-30 means about 70% in stock equity and 30% bonds, some cash, alternatives. Alternatives are things like commodities, real estate, asset classes that are not traditional asset classes. It also help mitigate some of the risk and volatility. Inflation, as you see there, consumer price index was about 6.6%. That's brutal. And that's just year to date. The aggregate bond index, this was a bit of a shocker. 9.9% year to date. Up until a few weeks ago, I think it was north of 12. As I said, we just bought some bonds to exploit that a little bit. That's actually, that's been a good story for the last several weeks. The NASDAQ, which is technology, is down to 1%. If you follow the market, you've known that that's a brutal asset class. It's, it's tough. It's tough out there with tech. And the S&P 500, the broad market, is down 13.3%. The yield on the S&P is 1.6. So our yield in this moderate portfolio is about 65% higher. I like manufacturing some runs, as they say, generating a little more income. But this portfolio has about 34% less risk. This is the aggressive portfolio. Once again, the moderate and the aggressive, we are a little bit defensive, and typically these things are a bit more aggressive, either one of them, but we're holding a little more cash than usual. So same story here, just different numbers. This is 11.9% down. All the other numbers are the same. This is its index. So it's 11.9. Its index is down about 12.7. The yield on this is a little lower because there's more growth. So once again, and I say this on every call, if you have specific questions about your specific situation, please find us. So just to end on a little bit of advice and a little bit of housekeeping. I thought about this because we had a very intense kind of attempt at a breach at somebody trying to get money from a client of ours. And to make a very long story short, there was some scammer out there who co-opted somebody's email, started sending us emails in a bizarre set of circumstances, actually set an appointment with me. I saw the request in an email for a bunch of money. It looked odd to me. I wrote back in an email. I said, hey, we got to talk about this. Sharon wrote back in an email, and whoever this person was corresponding with us as if it was this person, and then asked for a load of money that was extreme, and then wanted to change the checking account. We always use a two-factor authentication when it comes to money moving outside of the set instructions. And I want to point out something. You are never liable for money that's scammed from an account, whether it's us or Citibank or whatever. And we're not liable if we follow certain protocols. So Sharon actually called the client. We found out that this was completely fabricated, and we were able to move on. But they're very sneaky, and I wanted you to be mindful of stuff like this. Set up two-factor authentication for yourselves, whether it's sending a code to your phone or using a code generator, which is an app. Set that up so if somebody gets a hold of a password, they can't steal from you in any way, shape, or form. Electronic money movement. There's a lot of scams going around. The latest one I wanted to tell you about, which is quite effective, and you have to be very careful, is through the phone number-based applications like Zelle, Venmo, PayPal. Well, actually, I don't think PayPal, but Zelle and Venmo, I think, are phone number centric. And what's happening is people are saying, hey, send me your phone number. I got to send you money. And then somehow they're able to get in there and do something and steal your money. So I think a general rule needs to be, unless you're 100% or 95% sure about what's going on electronically, verify. Your emails, don't click on things unless you know it's coming, unless you're absolutely sure about the email, from the sender. Don't click on anything. It's a way for them to take control of your computer. Go to your credit bureaus, TransUnion, Equifax, Experian. Maybe it'll take you 10 minutes. You can put a credit freeze on your credit profile. It simply prevents credit being opened in your name. And then very little damage can be done to you. Nobody can steal your driver's license and social security number and open up credit if credit cannot be verified. Go to the property appraiser where you live. You don't have to go to the office, but go onto the website. And everybody has this now. So your deeds can't be stolen. This is a thing. Set it up with the property appraiser to notify you if there's a change in your deed or anybody's requesting information about your deed, and they will contact you. Almost every property appraiser now has this in place, including Dade and Broward County here in Florida. So finally, your credit. Some of you I know have credit monitoring services where you pay a subscription and it tells you all sorts of helpful things every month, like what's your score, what's happening. It'll alert you for any number of things going on. We have it in our family. At the very least, check your credit every few months. If you're a minimalist and you don't feel like dealing with it, at least once a year, you're entitled to a free credit report. It's annualcreditreport.com. And you get a free credit report once a year. And just check it to make sure there's no accounts that you don't know about. You know, it's not helpful if you never really look at it, and then 5 years goes by before you realize somebody's had a Visa in your name. Okay, so questions obviously come back to us. We're happy to help with this. And then a little housekeeping. So some of you know this, maybe some of you don't. Way back in the middle of 2019, Schwab purchased TD Ameritrade. And it's been this long period of integration. It's a multi-trillion dollar combination of two huge firms, so it takes them a long time to get their act together. So I wanted to start talking to everybody about what this looks like. So the good news is there's going to be no papering. We're not going to have to send you a bunch of DocuSigns. In the case of somebody who has some sophisticated trust or something oddball, we may have to do something, but for the most part, this is going to be what's called a negative consent. You're going to get something from Schwab, and you're going to say nothing. The only way you would not want to do business with Schwab or us any longer if you said, no, we no longer want to be in business with Doug Eaton or Schwab. I would hope that you call me first, but that's what a negative consent is. There's going to be a Schwab website. TD will ultimately go away. I will tell you that in my experience, the Schwab site is great. It's very clean. I know some of you out there have been on the Schwab platform before. I actually like it better. I think it's an upgrade, and we'll make sure that you're all set up. Your access to your information should be seamless. Your ID and passwords and everything will come over. And as this plays out, we'll make sure that you have access at all times. You will always know where your money is. You will always be able to see your values. All you have to do is let us know if there's a disconnection or anything like that. There's going to be an account number change. They have a different sequence of account numbers. But once again, if you have our portal, you're still going to have access to your accounts. If you have access to TD, to the advisor client, you're still going to have access to it through Schwab. And we're making an assumption that they're going to start announcing much more of this through Q3 and Q4 of this year. They have not yet told us an exact date when this is actually going to happen, when the switch gets pulled. I just had a call with somebody yesterday about how this is all going to look, and the definitive answer I got, which was very important to me, was there's absolutely no changing in any pricing or anything like that. There's no changing to anything that we're allowed to offer you, and there's no repapering. And I think that from a disruption standpoint and just a buzzkill standpoint, of all the things we could have happen, we don't want to repaper, and that's a good thing. So with that, I'll end the call. I'll let Lizzie let us know if there are any questions in the chat or anything like that, and I'm going to stop sharing. And please fire away.
If anyone has any questions, feel free to send them in the chat box, or you can just unmute and ask them now. Totally up to you.
I have a quick question.
Yes, sir.
I understand just the nature of investing in general. What is a good time frame for us to consider, reviewing accounts in terms of ultimate retirement?
Well, number one, in terms of reviewing accounts and situations and performance, and then when should you start thinking about developing an actual plan for an eventual exit from, your job are two different things. I think that number one, what I like to see, and I know who's talking. So what I like to see is for accounts that, are in this kind of 200 to $1 million range, it's appropriate to talk about what's going on in these accounts at least a couple of times a year, to review performance, to review what's going on. And remember, we're talking about things intra-review meeting. We're talking about things on calls like this, but it's good to sort of look at what's going on just for your peace of mind sake. I'm going to make changes anyway. And then when it comes to, hey, we have a 2-income household and we want to think about what cash flow in retirement looks like, I think it's important to start thinking about that no less than 5 years out from a theoretical end date.
Right.
So you're in that red zone of 5 years. You could start thinking about what a Tuesday afternoon looks like without work and get everything set up. If you have assets to sell, which I think you do, you start thinking about what that looks like to liquidate something. What does Social Security timing look like? So I think when you get into that 3 to 5 year period, that's very sufficient. I hope that's helpful.
Very much so. And you look good. And Lizzie's a fantastic addition to the team.
Well, thank you.
Thank you.
She sure is.
We have a question in the chat if you want to take that.
Sure. With the change to Schwab, did you say that advisor client remains unchanged? No, I said exactly the opposite. Advisor client is the TD proprietary name of the TD thing. That's going to go away. You're going to get the Schwab, he told me the name of it yesterday. It went out of my head in about 10 seconds. So I know for a fact it's going to be the Schwab portal, but the advisor client will ultimately go away. There's going to be some features that they pull over, but it won't look the same. It's probably going to be blue, not green. And, the look and feel will be different. But in my experience, the Schwab is a very clean interface. That work for you? Oh, okay. So who else? Okay. So we covered a lot of stuff today that was very planning centric, and a lot of it's very personal to particular clients and situations. And as I look around the room, I've had a lot of conversations with a lot of you, some very recently, about very real to do with cash flow planning. And everybody's situation is different, and it's very personalized. We don't institutionalize our advice. So by all means, contact me. Say, I want to talk, and, we'll go through it. And, it's fun to see a few of you who have actually just now started taking income, jumped off that plank and, living off the revenue stream from the investments and Social Security and so forth. So I'm not seeing anything else in the chat. Unless anybody else, anything, I'll let everybody go.
One more quick thing, Doug. Do you think you could email the graphic to us, the one that you used today?
Which one?
The last one that basically suggestions on what to do and the transfer to Schwab.
Oh, yeah, sure.
Great, thank you.
That's actually a great idea. Sharon has been working on the actual transition process, and we wanted to start giving information as it came out. But I'm happy to make a copy and paste of that. The problem that we're having is we don't get a straight answer from them on exactly when. So, what I think is probably going to happen, and I want everybody to hear this, is you're going to start getting correspondence from Schwab, and they're going to start dripping information out. You're probably going to see that imminently. But I'll send out that series of bullets. Thoughts on inflation? Stable for a while, still rising. There was a really interesting piece I read in The Economist about what happens when Federal Reserve ends, inflation policy too soon. They start cutting off the increases, even if it looks like recession. And almost every single time, it blows up what they had been working on. So it's apparent to me that they're going to still be aggressive. I don't know if we're going to see any 1-point increases in our future, but we'll probably see another 50 and maybe 75. it seems to have topped off. But let's not forget, I'm the guy who 2 years ago said that I thought that it was somewhat transitory, and I thought it was. So if we assume that a 4-year period is transitory, then I'm still right. But if we were talking about 3 months, then I was very wrong. I think that what I saw in the last print, CPI print, was that it is leveling off. And what I'm starting to hope for, and what I'm starting to think about, is that as we get into Q1 of 23, I'm hoping that kind of 4 to 5% tracking is there, and then we'll know that it's really working. So, that's how I see things. I think that we're seeing what's considered to be a soft landing, and hopefully that's where we're going. You'll see this again next month, and then it'll be a reaffirmation of what we saw last month, which is stability. I mean, look, gas is down 40%, right, from its high. So we're seeing some of that. I don't know about any of you, but going to the grocery store is still pretty horrific. So there's that. Joe, so hopefully that's helpful. Okay. Many of us out here are seeing the guy who's writing this is definitely out there on the west, the northwest, out in Oregon, are feeling the various brutal things lately that you outlined. What do you see coming in broad terms? Do you customize individual accounts to take advantage at some point? Okay, great question. So number one, what do I see coming? I have no idea. Literally have no idea. And nobody ever sees what's coming. You plan for what's in your household and what you may need. So planning for a recession is not that helpful, because if you're working and you're making $100 grand a year, and that's fine, and then you lose your job, recession wasn't a problem, and now recession is a problem. If you're living off of your assets plus Social Security, and there's a recession or there's a war, it doesn't matter. What matters if all of a sudden you have an uninsured medical cost for which you don't have long-term care, and then you have a problem. So therefore, I can't predict what's going to happen. And as you know, sir, and everybody, we're worst case scenario thinkers. The gentleman who asked me this question, we've just had a series of very intense conversations about what cash flow looks like in their household. So we don't customize individual accounts to take advantages of some things. We customize the individual household level of cash reserves, maybe make it bigger for emergencies. We might make an account that's a lot more aggressive, a little more conservative, because the amount of money coming out of it may be more extreme. So we do customize it, and we do try to stress test it. And I think that your question is best answered by saying the way we stress test a financial plan is the way you mitigate some of that tension or uncertainty from what may happen. So, and I see you on camera, so hopefully that's helpful. You can ask a follow-up while we're still here, or we can certainly get on the phone.
Hey, Doug,
Yes.
I have a quick question. On the globalization issue, we talked about that. Are you seeing any retraction of independence away from it now? Or are we still in this flux of, we're worried about Ukraine, we're worried about Russia, we're worried about China? Is our market getting more stable away from the globalization issue?
Well, so globalization is really this kind of concept where everybody was intertwined and everybody was doing business together. And that kind of blew up with China shutting down, Russia withdrawing from the world market, and everybody kind of focusing in on themselves. So globalization almost went away instantly. One reason that there was such a disaster back in 2008 was that everybody was tied together, like these counterparty risks with bonds, and everybody was interconnected, and we're starting to decouple. And you see a lot of that in Europe. You take Germany. Germany gets their gas from Russia. They get their defense from the United States. They sell stuff to China, and that's all going away. So I don't really know if it's going to be something like we're isolationists and everybody's on their own. But what I can tell you is that the way I've acted on this is I'm more U.S. equity centric at this point. You know, I don't worry about what I can't control, and I don't worry about nonsense. I'm looking at earnings and earnings growth, and I want to stay out of trouble. So I don't want to be a hero, for instance, and start buying Europe right now and wait it out. I'm in it with 5%. I don't see any real opportunity there. When the equity market was down 20% and Microsoft's cash flow was the same as it had been 5 months ago, and Google and Nvidia and everything, why not just buy that? You have no idea what's going to happen next with Putin or anything like that. And and as I said, one big problem with the United States monetary policy is it creates a huge amount of problems in Europe because everything that they're buying is denominated in the dollar. So that makes it very hard for them to pay their debt. I think the Greek treasury yield is something like 18% or something like that. And all the commodities that they have to buy just went up by 50%. I don't really care. I'm looking for a relative value. So, I don't work at the Brookings Institute, and I have no concept of where that's going to go. I just know that where I'm going to try to make my clients money. Okay. So I'm not seeing anything else in the chat. And I hope this was a little bit better pace today. My goal was to keep this to about a half hour in terms of my presentation. I think that starting late and when I finished, it was about 35 and a half minutes in. We've had more Q&A today than usual, which is nice. And I wanted everybody to be able to sort of know going into these meetings, now and in the future, there weren't going to be these 60, 70-minute, long sessions. So I'm going to try to keep the presentations to about 20, 25 minutes. And listen, I will tell all of you, I don't have an ego. There's a lot of smart people out here. If there's any suggestion you have on the presentation or anything you liked or didn't like or any feedback, please hit me with it. I'm fine with it. So with that, I'll once again wish Lizzie a good time tonight. And it's great to see everybody else. I'll look forward to speaking to everybody soon, and have a wonderful night and weekend. Thanks for being here.
Thanks, everyone. We'll see you next time, and be on the lookout for the link to the video if you'd like to watch it back, and any of the graphs that we talked about, we'll include those as well. So thank you all very much. It was great to see you. We'll see you next time.